Thank you very much, Nick. And I've got to say, what an absolute privilege and delight it is to have been invited here again. It's been a number of years. I've got to know a lot of you in those years, and terrific to be back here. As I was sitting, just collecting my thoughts, thinking about what I was going to talk about in my underpants, which, you know, it's a bit of a COVID thing from Melbourne. We worked for so long in isolation. I don't know if it's a confession or just an observation, but the last time I spoke to you, which was in October last year over the internet, you could see my shirt, but I was at a desk, and I think a lot of people in Melbourne just got used to wearing footy shorts through that period of time. It's in fact been 1,098 days since I stood here and made a talk to this audience, so it really is nice to be back. It's the first time I've really been out of Melbourne to talk to people, and it's such a large audience, I'm still coming to terms. It's almost like it's the first time again, so if I slip up, I apologise for that. Standard disclaimer. I thought I was going to have a panel of talkers here. Maybe they're all putting their ties on. I think this picture was actually taken by Mike Duclair, who you'll hear from a little bit later on. I was going to eyeball him as I stole his picture. There he is down the pack, and he hasn't put his tie on yet, so you can all take Mark's off if he speaks to you without a tie on a little bit later on. Mark's reappropriated some of my slides in the past, so I thought a picture probably wouldn't hurt. Read that one in your own time. I thought I'd start with a super high level, just précis of where key indices and things have gone. And when I spoke to you in October last year via the internet, I was giving a comparison of where key global indices had gone from the COVID crash in March 2020 up to that point, which was October 21. Things like the NASDAQ in America had almost doubled in that period of time, very short, circa 18-month period of time. In fact, it went on to double by the end of 2021, the NASDAQ. It certainly seems like a far more sober assessment standing before you now. And what I've got on the stage, on the screen, is just key Australian sectors broken down, as well as some of the key international indices, the S&P 500 and the NASDAQ thrown in there for a bit of a comparison. Probably the hardest hit sector has been technology. I think that's been in all the papers, so I don't need to go into it in too much detail. And that's the reason why things like the NASDAQ have fallen so heavily in the US as well. And even the S&P 500, which some of the largest companies listed in America are technology focused. In an environment that we're in, cash flows and comparing those to valuations of companies, I think, have come in a key focus of investors, and that's one of the principal reasons that these companies have suffered. The Australian market, almost neutral, about -4% calendar year 2022. Resources on the strong side, up 10% so far this year based on the key Australian indices. And I think there's a good reason for that. Hopefully I can paint that picture as we go. I'm always confused about where you've got to point the thing. You feel like you should point it at the TV and the receptor's probably somewhere down the back. The big question, and this is not a big reveal, the big question at the moment is inflation. Inflation goes up, rates have to go up. That's a classical economic thesis. When interest rates go up, it increases the cost of capital, and the impingement that that has on the equity market and equity valuations is that the future value of anything, cash flows that are going to come to you, are more discounted, so they become less in the present day. And when interest rates go up, you tend to see a reflection of that in the equity market one way or another. But what's being discussed or argued about in economic circles at the moment is how much of a permanent mark will inflation leave on the economy, on the global economy, or on the larger economies. And whilst this argument rages, because the stimuli here have been detrimentally affected supply chains because of COVID, impingement on supply chains because of Russian factors, things like this, they seem quite short-term and transitory in their nature. But a lot of economists are now starting to argue about how embedded this might be. And whilst that argument rages, the equity market sits on its hands. And when the equity market sits on its hands, it tends to drift. It doesn't go sideways, it tends to go down a bit. So I think that's an explanation, at least, for some of the behaviour we've seen. But I wanted to put that in context for myself. And what I've plotted here is the S&P 500. It's the longest data series I could get for an equity index, and it goes back to 1965. But it's a good one because it's a big economy and it's a global market. To look at this, though, over that period of time and make sense of some of the blips earlier on, rather than being swamped by the most recent performance, I've transferred that to a log axis, a log vertical axis. So you can see, going back to 65, there's been blips all the way along. And You can probably imagine what a fair few of those were caused by. You can see the GFC. You can even see the COVID collapse more recently. Overlaying on that, interest rates. So this is US 3-month Treasury bonds, government money, short term, and you can get a real sense of what interest rates have done in the meantime. You can plot any interest rate series on this. I chose that one because it's a fairly easy one to access for that period of time as well. And you can see there's been a period of time there with very close to zero interest rates going right back to 2009. Now, putting inflation on the top of this, US 12-month percentage change in CPI. Can you see what the fuss is about? It's the biggest spike in US inflation since the 80s. And I can hear the conspiracy theorists whispering there, they don't even calculate CPI properly. Perhaps, I don't know, I'm not going to go into that. This is just the government data I'm going on. There's two fairly significant spikes in inflation in this series, centred on circa the mid-70s and the early 80s. In both cases, they have impinged on equities. You can see the effects in the S&P 500 there. And the interesting thing about them is inflation doesn't bite. It doesn't have a collapse like we saw in 87 or even the GFC. It grinds. And it's been multiple tens of percentage falls over fairly extended periods of time as that inflation played out and then interest rates were brought to bear over it. And you can probably imagine that the market participants are sitting there every single month or quarter or whatever the economic data series is calculated on, hoping for a better imprint next time. Maybe it'll improve and then we can start buying again. And it's a death by thousands of cuts, maybe not even just 1,000. So inflation, you know, it's a really big thing in this economy that we're in, and it's the first time we've seen it for a very long time. And perhaps what this fuss is about is not sitting in the economy of the 80s or the 70s and seeing this inflation break out, but having sat here for 13 years in an era of free money and seeing inflation break out. And you might imagine some of the central bankers aren't all that match fit for what you have to do about that either. Time will tell. So I guess the question is should there be a fuss over that? And I guess the world is no stranger to bad news. I've got the S&P 500 here again, 2009 to now, so it extends from the end of the GFC to now. And in that time, there's been plenty of bad news events. You can overlay them. You know, any one of these could have had a material impact on the market, but in many cases didn't, and certainly not a lasting imprint. And what that, in my mind, sort of highlights is that this inflation breakout and what it's caused in the equity market so far is as significant as the taper tantrum in 2018. It's as significant as the COVID crash, at least in terms of magnitude, certainly not in terms of how quickly it's gone down. So how will that play out? And that's an excellent question. If I knew the answer to that, I certainly wouldn't be talking to you folks. I'd probably be partying on the moon with Elon Musk or something like that. But I'm not. I don't know the answer to it. All I can really conclude from this is that this inflation thing is a very, very challenging thing to be betting against. And I don't think that the market is betting against it. I don't think I'm on my own there to be wondering. I've thrown in the CNN Business and Fear and Greed Index, and this is calculated on a range of factors by CNN, so it's someone else's data. I looked it up this morning. The measurement has actually fallen from 28 to 25 now, so I apologise for not giving you the most recent information there, but I stole the picture a few days ago. And I think the outlook, inflation transitory, inflation embedded, boils down to a couple of things, and I've just put the bear case and the bull case there for you to look at. There's implications for commodities from either sides of this argument. And of course, the electrification of the world, the decarbonisation, sits very, very prominently in the bull case. And it sits there because that is a long-term theme which I have no doubt is going to play out. But we've got an inflation case at the moment which will be managed, and we've got a question overhanging the equity market as a whole as to how that will play out for the equity market and how that might wash into things like mining equity prices. So turning our attention then to the mining sector, and I should start with the observation that I think if this inflation thing, I think if it had happened in 2011, which was a heyday for mining, it was an absolute peak of the boom and peak of many of the bad behaviours which you can see when financial things really get out of control, I think we probably would have seen a fairly serious detraction in mining equity prices because we probably would have been sitting here saying earnings in miners aren't that great compared to their equity prices, which is the argument I suppose against tech at the moment. But that's not the case. Let's have a bit of a health check though. This is the ASX 200 resources index. So this is the best Australian index you can use for the health check of miners. Also includes a bit of energy, but includes BHP, Rio. They swamped this performance. And it goes 2002 to present. So you're seeing the last boom, you're seeing the global financial crisis in the middle of that, and of course the nasty boom bust we saw from 11 through to 15. And the levels of that index are now starting to tickle the peaks of 2011 and the peaks of 2008. I want to overlay on that, and this is where the health check comes in, the dividend yield of materials on ASX. Now, the materials sector is swamped by BHP, Rio and the bigger miners. So this is the yield of the resources index, if you like. It just goes back a little bit further. And I put on that as well the yield of the ASX 200 as a whole. Might have to split that out a bit further. And overlaying on that when the last mining busts were. Now, the first observation I'll take from this is the yield of resources stocks have typically reached a peak and spiked when there's a bust on. And the reason it does that is because their minuscule yield is boosted by falling equity values. What we've seen in the last 6 years, 2016 to present, is the opposite. We've been going through the building stages of a boom and now we're in the thick of it, and we've seen the dividend yield of the miners growing and growing and growing to the point now where it out-yields every other sector on ASX. So go figure. I don't know what the explanation for that is. I'm going to step forward a bit, but I'd like to break out. I've picked two periods from here, 2011 and 2021, and I've deliberately picked what was a zenith point, the absolute peak of the market, because I wanted to look at what financial conditions looked like when it was the absolute top of the game for miners. And in 2011, the miners made up about, I think it's this chart says about 21% of the capitalisation of the ASX 200. That's what the donut on the left is. I've broken out what the banks were, I've broken out what the energy sector was, and I've broken out what the rest of the market was. The ASX 200, the whole index, has gone up by 2.3 times in the intervening 10 years. And there's been a major adjustment in the pecking order, if you like, of that index. The capitalisation of the miners hasn't changed much point to point. It's declined in the meantime and come back up. Now sits at, what's that say, about 19%. But the interesting thing, and energy, of course, I think energy has reduced its capitalisation or share of capitalisation and dividends. Perhaps that's because the energy sector feels that anything it dividends out is less likely to be reinvested in the current sort of social overlay to the market. But the fascinating thing about this is that the dividend yield, the dividends paid out by the miners just in this index, is huge. The miners now account for 46% of the dividends paid out by the ASX 200 in calendar year 2021. I mean, for Christ's sake, you'd think the CEOs of these big companies were shareholders or something. It's amazing. That is a phenomenon which we haven't seen, and I'm not sure if this is a new paradigm or if it's just something which was forced on by 4 or 5 years of the market saying, you guys are so financially irresponsible, you've got a lot of things you need to fix. Whatever it is, I think it leaves the sector in remarkably good financial condition, particularly for the stage that we're in a boom. Comparing other high levels of the boom going back through the cycles, I think this is the best financial condition that you could say the large end of the sector has ever been in. And that positions mining quite uniquely in the current market. If there is jitters, and in fact I think just reflecting on what I said about the impact of inflation, does it give the market jitters or does it give it the absolute shits? Miners sit there in a very strong position to perform through a weakening or a weak equity market. So very fortunate about that, because the large miners cast the impression for the junior miners to investors for the whole of the sector. So if these guys are in good shape, then the rest of us should be as well. I want to look at the expenditures in the sector and how the mining sector has been investing in itself. And this first series is ABS data, Australian Bureau of Statistics. This is mineral exploration in Australia. And you can see the shapes of cycles here. You can see going back to, what are we there? I can't even read my own writing there. 1987 on the left-hand side, and I think it goes up to December 21 on the right-hand side. So exploration is reaching the levels, at least in terms of expenditure, as was reached in 2011. You can see the boom play out in this chart series. Exploration has taken off, and I think any of the CEOs who speak today are going to be telling you that they've had a massive delay in how long it takes to have assays turned around, and that's a factor of the boom. It's a factor of most companies all trying to do the same thing at once. Overlaying on that CapEx, and I should say this is a different vertical index, vertical scale. I've just overlaid them so you can see the comparative shape. 3.6 billion spent on exploration in Australia in 21, 38 billion on CapEx. So they're clearly different scales here. But the interesting thing about the CapEx line, and this is just CapEx in Australia, is that it really hasn't lifted far off the bottom. And this puzzled me a bit, and I don't know if this is a factor of it being Australian government-focused data. I don't know if it's because what gets reported in terms of intentions of CapEx spend is different to what gets reported in financials which go to the exchange. But a couple of other data points I should add to this are, if you were to just add together the investing cash flows of BHP, Rio, Teck, Barrick, all the global miners, there's a standard pattern there. The CapEx investments which they're making in their businesses now are roughly twice the level of what they were making in 17, 18, 19. But they're still sitting at less than half of what those levels were in about 2011. So we're sitting below the peaks of the last peaks, but I think we are sitting well up from the bottom there. And perhaps if we were able to look at this as a global series, that would stand out a little bit better. So the industry is investing. But on the accusation that the industry has underinvested in future supply, it doesn't appear to me that the industry is really rushing to catch up. And that's probably not a bad idea. I mean, if you're sitting there as a producer, you should be quite happy about prices being squeezed by external demand. And if you look at those things, if exploration has been re-embraced far more rapidly than CapEx, and bearing in mind it's still a much smaller amount of money, it does look as if the industry is investing further into the future rather than building supply now. It's looking for where the next 10 years are going to come from, as opposed to just bringing it out of the ground in the interim. Inflation, then, turning a mind back to that and overlaying it on the mining sector, it's generated by the sector, or felt by the sector, I should say, in different ways. There's been an impingement of COVID. That's weighed on labour forces. It's weighed on productivity and the ability to have people at their job working every day for all normal circumstances other than this pandemic. Post-COVID, supply chains as well have been, and I don't think you can really say that we are post-COVID just yet. We're still seeing the impacts of this. Conflict in the world, of course, has had a massive overlay on inflation, and the industry has felt that. But one of the things which is intrinsic to the mining industry is the behaviour of coinciding activities, exploration activities, building activities, all within the same period of time. Everyone in the sector wants to explore at the same time. Everyone wants to build at the same time. And that means that all of the particularly labour inputs get very, very stretched across the sector. And when you look at things like assay turnaround, which are incredibly labour dependent, they get stretched, they become more expensive. So the industry feels these things, and it plays out across the different activities. In exploration, turnaround gets slower. Access to a drill rig gets harder. Operating costs, particularly when you think about the energy inputs and the labour inputs, which are probably upwards of 60 or 70% of the OPEX of most mining projects, it has a huge impact on cost. One thing we haven't seen a lot of, because it's been a muted behaviour, has been CapEx, but we are now starting to see a pattern of budget, I shouldn't say blowouts, but I think people are definitely starting to eat into their contingencies, and I know a lot of people who have been developing projects have felt very, very nervous about what the CapEx is going to be by the time they've finished spending it. This has been moving so quickly. If you take 12 months to build a project or build something, you price it at the start or well before you start, and then by the time you get to finish spending it, that number has gone up. So the industry feels that as well, and that overweighs the way that investors feel about the industry, because if you're delivering big catalysts to the market, we've come in on budget or we've come in on time, you've now got the potential for that to turn from a neutral or at least a mild positive into something which is far more likely to be a negative. And I think that's something that the market is going to be judging companies on, despite the state of commodities. But the flip side of this is that miners make commodities which are hard assets, and in times when inflation starts to bite, investors start to look for access to hard assets to put their money in. I mean, precious metals are a big one there, but most commodities are viewed as hard assets one way or another. So miners should be the beneficiary of this at the same time as they're suffering from it a little bit. Shifting from the majors into the juniors, and by this I mean the explorers, the developers, even some of the smaller miners, ranging from people who might need to raise 100% of what they spend right through to a small working capital top-up from time to time from the equity market. Really, the series you need to look at for a health check on the juniors is capital raising trends. Because if they need to raise the money, they can't spend it if they can't raise it, or if they can raise insufficient money to carry out their plans. So fundraising in the juniors, 2021 was an absolute record year. I think it was the second largest number of IPOs of explorers onto ASX since 2007. So it's the second highest ever, 2007 being the highest. In Canada, the TSXV, where all of the smaller miners and explorers reside, it was the largest amount in equity raised by that sector ever in the records that they keep. On ASX, I don't know if it was a record, but the 5B reporters, so that encompasses the explorers and developers and a few of the smaller miners, went from what was a normal year in, let's say, 2016, 17, 18, 19, raising $3 to $3.7 billion in the year collectively, to raising 9.7, so it almost trebled. And it was an enormous year in, I think, the amount raised by IPOs as well. I don't have that data, but it was a year when we saw some of the larger IPOs come to the market, which tells you that liquidity is running extremely hot. You can't raise $100 million to list a company if the market isn't incredibly liquid. So those things are all standing out to me to say that 2021 was a big year for those fundraisings. I've already said that. 2022, what's that going to look like? Liquidity series tend to be very granular, quarterly at best. So all I can tell you as a snapshot of how that's going is the TSXV is tracking at about 60, almost 70% of what was raised year to date last year. So I don't think that market, which is no different to Australia really, is going to raise anywhere near the amount that was raised in 2021. That's not evidence of a turning point in itself. I think it just tells you that the market has tightened, and whether it's a little or a lot, we'll see play out over the rest of this year. But the same thing which has affected tech, if you don't have earnings, your equity price might suffer, is probably affecting a lot of the junior miners as well. And having said that, I think that, reflecting on what a lot of the smaller company CEOs, the brokers, etc. are telling me, is it is definitely harder to raise money this year than it was in 2021. So we'll see. It's tied to inflation, I'm sure, and whether that eases or gets harder, we'll tell as time goes on. I wanted to sort of wind into the finish by seeing if we can get some guidance from history here and looking for a bit of guidance from the last two major corrections that we've seen as equity investors. And I've got three lines that are going to plot out here: the Australian ASX 100 Resources Index, and then the other half of the Australian ASX 100, which is the industrials. And below that, for something completely different, but really just to represent tech, I've got the American NASDAQ. And the time frame here is 2002 to present, so there's circa 20 years on this page. And what I want to look at is two events: the dot-com bubble and then the tech wreck, which was late 90s, early noughties, and the global financial crisis. Now, tech has been a feature of what we're seeing in terms of equity market declinations at the moment, so the tech wreck seems relevant for that, although the driver of the tech wreck was not inflation, and what we're seeing at the moment is that, so I'll be very clear about the drivers. And the global financial crisis was a global financial phenomenon which impinged the equity market quite significantly. The tech wreck was an interesting one. Whilst there's a meltdown going on, and particularly if it's sector constrained, it didn't have much of an influence on the Australian ASX 100 indices. Now, I know there was an influence in Australia because there was a lot of smaller companies in the tech space which were slammed, but the larger cap stocks in Australia weren't. And I think that's probably the same phenomenon as we see now. NASDAQ tech heavy, Australian market resource heavy, tends to buffer it. Even the industrials to an extent didn't feel that quite as hard as the NASDAQ did, and it collapsed over a long period of time there. The other interesting thing about this, though, is that when one sector was collapsing, we didn't see another sector, which tends to get a lot of risk money flowing into it, rallying until that event was well over. And I don't think there's any coincidence between the tech wreck being spatially different from the mining boom, which then happened from the early noughties onwards. I think if money was avoiding one sector and seeking another, that's why it's gone from one place to another. Fast forwarding to the global financial crisis, I think one of the curious things about this, and it's worth pointing out, is that the mining indices were much, much slower to find a peak than the industrial indices or the rest of the market was. The global market started collapsing with the advent of Bear Stearns in 2007, The mining market went on a good 8 or 9 months after that, and it wasn't until the Beijing Olympics had finished and the Chinese commodity buyers really didn't come back to the market as hard as everybody thought they were going to, that the mining industry started to collapse. And they came to the bottom, they found a bottom more or less the same time as everything else. So there is this tendency for a very strongly supported commodity market to defy gravity for a little while, and I don't know if there's a warning in that, because as I said, we don't know how inflation is going to play out. But if we find ourselves in incredibly hard times, I think that's something that we need to be quite mindful of. So far in this little episode then, I've plotted the same lines but on a much shorter time frame. So this is July 21 to present, only a few months. How do they overlap? The industrials in Australia have followed a fairly similar shape to the NASDAQ. And I don't think that's because the industrials is tech heavy. I think there's so many things in the market, consumer discretionary type companies, telecom companies. There is a large input of tech into a lot of the business models of a lot of what has grown, particularly in the Australian market, as much as the Australian market, which sits outside of resources. So the two have marched almost in lockstep as this market has turned around in 2022. And you can see there that it really is a phenomenon of 2022. 2021, it's sort of finished and flattened before it has come off a bit this year. The miners, on the other hand, or the resources sector, I should say, is well above that. So that's carried on nicely. So to draw all of that together, the Lion Clock is something that we use at Lion to encapsulate how we see liquidity flowing in and out of the mining sector. At the top, you've got a crash, which is midnight. You go through a bust. You get to a boom at 6 o'clock, and one of the indications that a boom is starting, and I don't mean people are starting to do outrageous things and expenditure is flying. I mean that the boom is starting to get to the point where activity measures can tick up rather than continually ticking down. That's at 6 o'clock at the bottom of the clock. We've wound right around to 11 now. The reason I'm very confident we're at 11 is because all of the liquidity indicators which show money flowing into the sector have been hitting new records. We've been seeing very large IPOs in 2021. And we've definitely seen a pullback from that. It doesn't mean the clock goes backwards. The question it raises in my mind is, where does the mining cycle play out from here? I've said previously, and I think I might have said it last year in October, that 11 o'clock on this clock can last for years. It's the best time in the mining cycle because this is when the juniors really perform. You put out good news and your equity prices go up. You're not speaking to an empty room. You're talking to investors who really want to hear your story, and there are exciting themes to follow. At the moment, electrification is one of those. So this still could have time to play out all on its own. The biggest risk I feel that exists to the mining sector at the moment doesn't come from the mining sector. It's in excellent health. It's from the equity market as a whole. And if inflation really starts to grind that down, then the miners will have to follow at some stage. I'm sure that will generate opportunities, because if we've got a well-cashed and very financially healthy large mining population around the world of large cap miners, then I think they'll be very opportunistic with that, and they'll get the next cycle started very, very quickly by acting on M&A. Hopefully we don't get to that. So my conclusions, I suppose just to step through them one at a time here. The first one is, and it's fairly obvious, the equity market has fallen, it's corrected, it's been tech-driven, and that's the largest thing where hot air has flown out of valuations, I suppose you could say. Miners have stayed strong. Junior miners have probably suffered for the similar reasons as tech, not having earnings. They've been punished a bit on the equities. I think from what I'd said about dividends and the financial health of the miners, the market could definitely afford to pay more for those companies. But the question I have is, will it? And where I personally feel that'll play out is that the mining market will probably not rally strongly until what has happened in tech and what has happened in consumer discretionary has finished happening. So if it's going to grind down, you'll probably see that money come to mining only after it is finished on one side of the market. Inflation is definitely a thing, but the question is for how long, and I just think it's far too early to be betting against that. I don't feel I'm too distant from the equity market there because a lot of investors are clearly on the same page. And the final one there, and I can't even read it and it's not in my notes, so you're going to have to read it for yourself there. The miners are incredibly financially healthy. This is probably the most financially healthy we've seen the large miners at this stage in any boom. And that positions them absolutely perfectly for a period of equity market weakness, whatever that plays out to be, whether it's a little or a lot. So I think one of the strongest performers over the coming months and years are going to be the miners. It's a question of what that's a relative comment, it's a question of what the absolute is. And I think that's one's a little bit hard to call at the moment. So I'll finish really just by saying what an absolute pleasure it is once again to have been invited here. Nicholas, Sharon, Paul, thank you very much for your hospitality. You always look after me really well. It's wonderful to talk to all of you. I find myself standing here with a little bit of a wind in my sails as well, because most years when I've come, I've been looking at all the companies outside here and thinking, Lion's investment portfolio was fairly fully set, very little cash in it. In the last 9 months, we've sold 2 very large investments, and come February next year, we're going to have around $85 to $90 million of cash, which is investable. So all these opportunities that we perceive from whatever happens in the market, we're all set to take advantage of. So like you, I'm going to be talking to these companies with a great deal of interest and assessing those really from the perspective of can we act on those. Lion's trading in the market at a discount to that cash, so if you want to check that out for yourself, I invite you to, but I'll be around for 2 days and more than happy to have a chat. That brings me to an end, and I now swing into the next part of the program, which is introducing people. So I've done what I always do, which is forget to bring my notes up.